The tariff landscape has been ever-changing since President Trump took office. 25% tariffs on Canada and Mexico, an additional 10% on China taking effect on Tuesday. But then the auto industry getting a reprieve from Trump today, at least for now, for a month. We haven't even gotten to reciprocal tariffs, which is a point of focus for our next guest. Joining us now, Stephen Roach, senior fellow at Yale University's Paul Tsai China Center, and of course, formerly with Morgan Stanley. Stephen, it's great to have you here and to get your perspective on these issues. We were just talking to a longtime investor and strategist who said, you know what, maybe all of this tariffing is going to turn out well, and we'll end up in a better strategic position when it comes to global trade. Do you see a path to getting there, Steve?
Not at all. I think, there's lots of maybes in the world, but you also had a segment that I heard the end of on stagflation and tariffs, whether they're bilateral, multilateral, reciprocal, asymmetric, you name it, they are a negative for inflation and a negative for growth. And most importantly, the thing that worries me the most is this on again, off again. Here now you see it. One day it's 25% on Mexico and Canada, and then the next day maybe it's off. 1 month exemption for automakers. The president is very much in the camp that he continues to stir the mix and keep people guessing. Well, we know from doing economics of uncertainty for a long time that uncertainty is the enemy of decision making, and so he's really changed the sort of the framework by which businesses are making medium to long-term decisions with respect to hiring and capital spending. And I think as long as the uncertainty persists, and it looks like it's here to stay for the foreseeable future, that is going to retard those key aspects of economic activity, and that fits in with the stag part of your concerns over stagflation.
How, Stephen, do you try to think through and model the impact of tariffs on economic growth when we don't even know how long the tariffs are going to be in place for?
Well, you make assumptions, and those assumptions challenge the point I just made, because, again, he says one thing and ends up doing another within a very short period of time. But under the presumption that, say, on China, which is what I focus on a lot, that tariffs on Chinese products coming into the United States, going into his second administration, were about 19%. That was courtesy of his first round of tariff hikes in 2018, 2019. And now he's announced 10% on top of that, followed by another 10%. So I assume that that he's only going to ultimately settle on one of those 10%, that the other one is sort of a negotiating ploy. And then based on that assumption and modeling it through export dependent China, for example, you can knock a full percentage point off of Chinese economic growth this year, and you can knock about a half a point off of U.S. economic growth this year as well, working it through the structure of the imports that we get from China.
And Steve, as you said, you're somebody who watches China closely. You have for decades here. So put things in perspective for us in terms of the negotiating power of China now versus, say, the first Trump term, and what they perhaps have to offer the U.S. to maybe avoid part of these tariffs.
Well, we saw this at the end of the first Trump administration, where the U.S. and China cut this so-called phase one trade deal, where China agreed to buy $200 billion of extra goods within a stipulated 2-year period. China turned out not to have done that because of a lot of extraneous circumstances, not the least of which was COVID. But China is our third largest export market and had been our most rapidly growing export market until Trump's tariffs came into play in 2018 and 2019. So China's got a lot of buying power, whether it's finished goods, U.S.-made technology, or we know from the first Trump administration, tremendous need for agricultural products. So, China's holding a lot of, pardon the pun, Trump cards that it can hold out to the United States. We have a two-way relationship, which means that China depends on our markets, but we also depend on them. And so there's plenty they can give at the negotiating table. And as we're seeing right now, they've threatened almost immediate retaliation each time the president has moved in the last few weeks.
Steve, when all is said and done, is American exceptionalism at risk, or is it already sort of past at this point amidst all of this?
It's a fuzzy construct. It's hard to, actually define it. But to the extent that it represents the ultimate in soft power personified by our moral, ethical, legal underpinnings. You can certainly raise more questions about that today, especially in light of what's going on in foreign policy with respect to Russia and Ukraine, which came to a head a little less than a week ago in the Oval Office. The American exceptionalism has been, as squishy a concept as it is, has been a major underpinning of the strength of the dollar's role as a reserve currency. And so if it seriously is past its peak right now, and there's a case to be made for that, then that draws a lot of assumptions into serious question that also underpin world financial markets as well as the global economy itself.